Is the 60/40 portfolio dead? That's the portfolio that has 60% of the portfolio in stocks with the expectation of growth and 40% of the portfolio in bonds with the expectation of both reduced volatility and some income. It's not working this year. Should we give up on it entirely? Stay tuned as we discuss all this and more right now on the Retirement Lifestyle Show. Welcome to the Retirement Lifestyle Show. I'm Eric Olson, one of your co-hosts, along with my two partners in this week after week, at least when one of us isn't missing, Roshan Loungani and Adrian Nicholson. Hey guys, how you doing today?
Doing great. Thank you. Thank you for asking. I'm looking forward to discussing our topic for today. Today, we're going to be talking about the 60/40 portfolio. And I think this is an important one because from what I've seen, that tends to be a standard in the investment industry. So a lot of you that are listening today, it may not have been called that. It may have been called that, but a lot of you have that portfolio with your financial advisor. So recently this year, I've seen some stuff actually as far back as last year talking about, is that portfolio dead and should you shift away from it? So today we're going to be discussing that portfolio, where things lie right now. We've got a lot of good historical comparisons that Eric, that you've prepared, and we want to give you things to think about while you're considering your portfolio and what to do after this tough year we've had so far.
Yeah, I like how you put that, Roshan. We're going to talk about things you should consider and think about, and this is going to be a heavy investment episode, which we are always excited to talk about. We like our investment topics, as you probably know. So these aren't recommendations. This isn't general advice for you. If you do have questions, feel free to reach out to us. We're always happy to answer that, or any other professional you work with. And we're really excited just to get into this topic today, guys.
Yeah, absolutely. So to our listener, when we talk about the 60/40 portfolio, that's shorthand for saying 60% of the portfolio, in the very simplest terms, is oriented toward growth. And that's usually expressed through stocks. And then the other 40% is oriented toward more protection and potentially income, if there's income to be had. And that's normally expressed through bonds. And so conventionally, a typical way of super simplifying this for academic research purposes is to say, we'll take the 60% of that portfolio and we'll have it entirely represented by the S&P 500. By the way, most people wouldn't do that, but in these days of great higher diversification, but for research purposes at least, and comparison purposes, that typically is the individual tool or index that fulfills that 60% piece. And then the other part, which is the 40% part, depending on who you ask, will sometimes be filled by long-term treasury bonds, although generally that's kind of frowned on. And instead, the other 40%, that 40% would instead, these days, typically be filled by what's known as the Bloomberg Aggregate Bond Index, formerly the Barclays Aggregate Bond Index. So what we're looking at then is, how do these two broad asset classes behave when they're put together into a portfolio? And we can look at that in a deep historical perspective, both from a vantage point of what's normal, and then we can also look at it from when it's been abnormal, particularly uncomfortably abnormal. I don't find people normally complaining when a 60/40 portfolio is sizzling hot, but when it's having a rough year like it's been having this year, then that's a different story. So, gentlemen, I have some charts to share, but I wonder if you would like to add anything to that before I jump in with some charts.
Let's start with the well, you know what, actually, let's start here. I want to ask both of you, and actually I'll share my opinion first, but the question is,
Great.
Is 60/40 dead? And we can go into our rationale, and we'll go into the data, but I'm going to ask you first, and as I said, I'll answer it. Is 60/40 dead? My short answer is no. Adrian?
So my response would be no as well, because I guess is the question back to you all: can investment strategies really die, or do they just have times where they're not doing well, where no one really knows what's going to happen in the future? It could come back. There's always that possibility. So just to say it's flat out dead, it's not coming back, doesn't seem like that's the case for me.
Eric?
Wow, that was a
Yeah.
sage answer. Yeah, I would also say the answer is no. Although, if I look at how I actually behave, it isn't typically the case that I am recommending for a client who may have, let's say, a moderate asset or moderate risk tolerance, that I'm recommending strictly a conventional 60/40 portfolio. Usually, there are other moving pieces in that portfolio that I introduce to the client that we use to further diversify that portfolio. So maybe then, whereas I may say it's not dead, perhaps just the evidence of the way in which I normally prescribe or recommend to clients how they allocate, maybe my actions suggest I actually do think
Yeah,
it's dead.
you bring up what to me is a different point in conversation. We've talked at length on our episodes on how we help our clients manage their money, and please, everyone listening, feel free to go back and check those episodes out. What you won't hear us talk about on there is the 60/40. Right. So I think to
Mhm.
me the conversations how they're different is one, today's topic of is that portfolio dead or not? And we're doing that to help the listeners because so many of you are in that portfolio. Even though Eric, Adrian, and I do something different from our clients, that there's still a uh, huge chunk of people that invest like that. I don't have a percentage, but I wouldn't be surprised if it was the majority, quite frankly. So to me, the question of is the 60/40 debt is different from, well, how do you manage money? Because I don't tend to use this very much either.
Mhm. Well, I want to just clarify. I do have it as a core holding for many clients, but it would be not the entirety in most cases. And just let me clarify that. Why do I say most cases? Why would I ever have it where it was the entirety of the portfolio? Just at a very simple behavioral level. We've talked about behavioral finance in the past. I think when a new client starts working with a client, when a client starts working with an advisor for the first time, there's some extension on the part of the client to the advisor, some extension of trust, but they're also saying, uh, you have to kind of prove it, or you have to verify that you're trustworthy. And if the relationship starts out right away with you talking about things that seem, um, let's say, new or sort of uncommon or foreign concepts, I think for many clients that just serves to it takes them longer to reach a point of saying, okay, I think I know how this advisor thinks, and what that their recommendations are indeed centered around me, and they're not just riding some sort of hobby horse. And so on that basis, I will typically start with what the client knows or what the client believes about a familiar pattern of investment. And then gradually, as we get to know each other better, I will then introduce these other approaches, usually strategies, factor based investing, alternative investments, and such, to augment and complement that core. Is that how you work, or are you just pretty much straight into saying, when a new client starts working with you, hey, look, let's not get trapped by this outdated model? How do you approach that?
Well, so what you just described to me, Eric, is basically saying you don't do the 60/40 anyway. You like augmenting it with these other things, right? And uh, so
Uh-huh.
yeah, I would. Uh, I think everything we've got to do has got to be a certain degree individualized because every client's different. At the same time, there are
Mm-hmm.
core tenets and investment philosophies you have that will not vary, right? So I think
Mm-hmm.
we definitely customize things to the client. But if I like whether it's portfolio or stock or whatever it is, if I like a certain thing, I think it's a good opportunity or a good investment. I'm not necessarily holding it back from somebody, right? So I am definitely sharing. And
Mm-hmm.
so
Mm-hmm.
I think I guess what I'm saying is philosophically, I'm not necessarily saying the 60/40 is bad. I'm saying there are other things that I think are better, right? So
Hmm.
yeah,
Okay.
but getting back to the topic for today, I think the reason we're reviewing this, as I said, is because so many people have this portfolio. So a lot of our listeners, this is what you own, whether it's called that or not, and we just want
Hmm.
to discuss whether should you stick with it or should you look at something better under the context of what three guys that are constantly studying and reading finance news has been seeing a theme of a lot, which is that portfolio dead now?
Yeah. Okay. Well put. Well put. So let me share some data with our viewers. Now, if you're just listening to today's podcast, I'm going to do my best to describe this, and we'll all pitch in and give some descriptions here. But if you can go to our website. That's retirementlifestyleshow.com. And you can just go, if you're hearing this right away as it's released, which will probably be, if I'm doing the math right, on November 2nd or thereabouts, then you can just see it. It'll be the first thing that comes up on our webpage. If you're listening somewhat later than that, then what we'd have you do is go up to the All Episodes tab at the top of the page, and then just they're all there in reverse chronological order. But that doesn't mean you have to scroll through especially if it's gotten to be a while later, quite a while later since we recorded this, that you're listening to it, then you can just go up to the search box and you can type in 60/40, and it probably should it should surface this episode. But then you'll be able to see the charts, not just hear us describe them. Sound good? All right. So let me share my screen here, and we'll just go with these screenshots. So I'm going to start with graph that was built by Morningstar, or built by Vanguard using Morningstar data. And what this is doing is taking data from 1926 and running it all the way out to 2019. So inclusive, that's 94 years of market behavior. And what they've done here is to construct a display or a graph of 3 data points for each of 10 different portfolios. The 10 different portfolios are uh, portfolio number 1, 100% bonds, 0% stocks at one end of the spectrum. And at the other end of the spectrum, 0% bonds, 100% stocks, with the other 8 portfolios, or I guess it would be, if I'm doing the math right, there's 11 portfolios in total, with them sort of shifting 10% at a time. So 100 and 0, then the next one is 90 and 10, then 80 and 20, and so forth. For each of those portfolios, they're showing what was the average return over the entire measured period. And what they're then also showing are the extremes, the worst single 1-year return in each case, and the best single 1-year return in each case. And as it probably as you probably would expect, the heavier the allocation of stocks over that 94-year period, the more the average return that you had, and also the wider the dispersion of returns in general. So let's just look at let's talk about the 60/40 portfolio here, as we've been discussing, which in this case, from left to right, is the 5th one from the right, I guess it's the 7th one from the left. It's depicted here as the 40% bonds and 60% stock portfolio, but that's what we're talking about. Its return on average over those 94 years was 8.8%. Its best 1 year and its worst 1 year were, respectively, 36.7% to the good and minus 26.6% to the bad. So that's the history for all of this. So that's what's at least considered normal. Gentlemen, when you look at this, any questions or observations?
Well, it's a long. There's a good sample size here, right? Going from 26 to 2019 that you've got on here. So we're looking at just under 100 years. So I
Exactly.
think it gives you, because if you look at a narrow time frame, especially in recent history, um, that 60/40 has outperformed that target. But I think that it's very valuable to look at this time frame. The other thing that stands out to me is, and you may be waiting to share this, Eric, but that worst performing year is minus 26.6 on there. And
Hmm.
do you have an update as to what that looks like right now in 2022?
Yes, I do. So I'm going to actually talk about this in several ways. So I'm going to scroll through a couple
Mhm.
other tools in here. Let's find. So let's find this one. Here we go. So on this case, I'm going to pop through a few pages here, and I'll show you kind of how things have looked recently. So this is just a commentary from Meb Faber, whom you may we've mentioned in the past, and what he's looking at. If you look at over the last 100 years from when this was published, then the worst of the 5 worst years for U.S. stocks and bonds allocated in that 60/40 portfolio were that the worst single year was in nominal terms a minus 31. That was in 1931 as well. The second worst was minus 22. And at the point at which he gave this tweet, which was September 29th, then for 2022 to this point, it was minus 20%. But that's not the end of the story. If you look back at how that stands in terms of intra-year maximum drawdowns, it's also worth noting that the calendar year is slightly misleading. If you instead looked at intra-year, you can see, for example, back in 1974, 75, in that range, you had a peak to trough drawdown on the 60/40 portfolio that was as deep as 33.6%. And you saw it again in early 1980s, close to 32% drawdown. You see in the global financial crisis, when in 2008 and 2000, early 2009, a peak to valley decline of almost 29%. So in that respect, we're not from we'll say 1970 forward, we're not even in at this point in the top 5 deepest peak to trough drawdowns. We may get there, but we're not there yet. If we then say, all right, here's another display that was put together by Dimensional, which is or Dimensional Financial Advisors. They run some mutual funds and some exchange traded funds and so forth. They did this through the end of September. Of course, we're having this conversation in late October, but at least this graph is the one that I could find. What this was showing is that those top 5, in looking at the peak to trough drawdowns, they even found one in 1936, and I think this is a slightly different composition to their 60 and their 40. They found one in 1936 that was as deep as 62%. So from that vantage point, it looks like at this point our year to date drawdown is not what we would consider to be um, without historical precedent. And I think that's the key point, is to understand there are indeed precedents for these kinds of drawdowns, and therefore the statement that some are making that this is dead, I would say no. This has precedent. It's been a long time since we've seen declines of this magnitude, but it's certainly not without precedent.
Yeah, and going back to what Adrian said earlier, uh, is 60/40 dead? I mean, that's when I think he said it perfectly. These different strategies have their different times or different opportunities, and it just reminds me of the article years ago that said, equities are dead. The death of equities. It was a
Uh-huh.
headline from Business Week from August 13th of 1979, and if you stayed
Hmm.
out of equities because you thought they were dead from then to now, you missed out on a lot of money. Like Buffett became a billionaire with equities in the in the time frame that they said equities are dead.
Yeah.
So
Yeah.
I think, yeah, the time frame is an interesting thing to look at. There was we were talking about a tweet or information that came out uh, from Bank of America that is just a couple weeks old, where they had said this is the worst performing 60/40 portfolio in about 100 years. And it's interesting that
Hmm.
you had mentioned peak to trough drawdowns, which and they're
Hmm.
looking at calendar year performance when they're saying worse than 100 years.
Right.
So not that
Hmm.
one's better than the other, it just shows you how the data point you pick can support the argument you want, right? So if
Isn't
you want
that
to
true?
say, things are crazy and it's the worst it's been in 100 years, that's accurate if you pick the Bank of America data point. But if you pick Eric's data point where you're looking at peak to trough drawdown, it's not, right? So
Hmm.
I do, as our listeners that have been around for a while have heard me say before. Sometimes I think these are people getting paid to write articles, need to find something to write an article about, and call something dead. You create clickbait, and you can have a more popular article out there. I think there's some of that going on,
Or
or
a
podcast.
podcast.
Yeah, yeah. We're not excluded from that group sometimes. So that's where I think the whole statement of is this dead goes. Now at the same time, while reading and researching this, I I did see some interesting points. So first, let's talk about why. Why are we going through this? Well, if inflation's high, causing rates to go up. When rates go up, what do bonds do? They go down. When rates go up, what do stocks do? They go down. So if you've got 60% in stocks and 40% in bonds, and they're both going down, you're not getting the diversification aspect that you want from the stock and bond portfolio. The diversification aspect, or the negative correlation that you'd want when one goes up, the other goes goes down. Well, you're not getting that kind of protection now because interest rates were just so low. You've got the same catalyst driving each. Now that it's already
Hmm.
gone down that much, and you're going from 0% yields on your bonds now, where you can look out and get almost a 5% yield. Well, if you look from this point going forward, I think you will see the diversification aspects coming into play. Now, not next month, or not necessarily next month or a few months down the road, but from a long term perspective. Because if you can get 5% on your bonds, it makes sense to have money there. And then from a total return perspective, if rates go up and those bonds drop by 5%, well, you still broke even, and the stocks more than likely would have gone
Hmm.
down in that scenario.
Hmm. Since we're talking about diversification and the diversification effects of bonds, let me share another screenshot then here too, because what this will do is just illustrate the point that you've just made. What I found was a couple of graphs that I thought were useful. So this was, pardon me, this was developed by Morningstar. And what you're looking at, again, for the benefit of our listeners, since our viewer can see this, you're seeing a timeline that runs from 1988 until when this was concluded, which was at the end of September of 2022. So the timeline left to right. And then on the vertical axis, what you're seeing are the degree of correlation between stocks and bonds. Here again, these are rolling 1 month correlations between the S&P 500 serving as the index for the stocks, and then the aggregate U.S. The Bloomberg U.S. Aggregate Bond Index serving as the representation of the bonds. And so all of you think back to your college statistics classes, you remember correlations, you can only go all the way to +1 or -1. So that's the correlation that we're talking about here. What you saw in the period from 1989-ish until about 1997, or even, a little choppy, maybe even extending until about 1998, 1999, was a virtuous positive correlation between them when markets were rising. So also were bonds. Why were bond prices rising? Because the interest rates were being gradually reduced over time, and with that the inverse nature of bond interest rates and bond prices. As the interest rates came down, the prices went up, and that was going up at the same time as the stock market was. Then you got into inverse correlation, and that period, this is especially during the tech bubble, that was actually constructive to have an inverse correlation, right? Because then your bonds were coming a little bit to the rescue when stocks were getting punched in the face. And the same thing was true during the global financial crisis, that for the most part, as things began to unwind in 2007 and continued to do so until early 2009, again, stocks getting punched in the face, bonds coming to the rescue, an inverse correlation. But from that, coming out of that period, then what you had was a negative correlation. As the stock market rose, the bonds were not closely on a month-to-month basis correlated with stocks. And now, more recently, what we've seen is a spike in the positive correlation. One being COVID, and then most recently, the last few months, or let's say since the start of 2022, thereabouts, what you're seeing is this strong positive correlation at precisely the time you wouldn't want it, which is when both of those two broad asset classes are collapsing. So the diversification in this case isn't really doing what it's supposed to. Long run, what you see, and I'm showing another chart now for you, our listener, where this is showing another way of sort of understanding correlations between stocks and between bonds. Over the last 10 years, what you found is that short-term treasuries and long-term treasuries have a persistent inverse correlation. True corporate bonds have a somewhat positive correlation. But wow, in 2022 year to date, everything is this strong positive correlation, especially with corporate bonds and core bonds. But treasuries are right there with it in a really extreme way. So from that standpoint, what you're seeing is that just another way of gaining some perspective on what's taking place recently and understanding how abnormal what we're going through right now actually is.
It definitely is a strange time with that. But if you think about it, like on that chart you showed you had mentioned COVID and the correlation there. Well,
Mm-hmm.
everyone was scared of everything for a good month and a half, just sold everything, right? Which
Mm-hmm.
bonds weren't
Mm-hmm.
immune to that, right? And so I think
Mm-hmm.
right now you don't have everyone scared of everything, but what you have with interest rates going up, and I'm sorry, with inflation going up as well as interest rates, you've got a situation where these things are going up and those securities typically react in this fashion, right? So what
Mm-hmm.
is abnormal is both stocks and bonds going down. What's not abnormal is that when interest rates go up, they both decline. And I think we're seeing an
Mm-hmm.
extreme of that. The reason we're seeing it so extreme is
Mm-hmm.
because you're going from basically zero interest rates, right? And yes, it is the fastest rate hike in
Right.
history. That is accurate as well. But going from 0 to 1 is an infinite change. Going from 1 to 2 is a doubling, right? If you're at 6%
Mm-hmm.
interest rates and you go from 6 to 7, that's not going to have as big of an impact, right? As going from
Mm-hmm.
1 to 2.
So true. So how then we touched on earlier in this episode, if someone were to say, okay, I understand this is abnormal, therefore I'm not going to entirely throw in the towel on the 60/40, but I am interested to understand what I can do either now while this correlation is so strong and they're both dropping, or that perhaps I should just do not only now but also longer term to to uh, further truly diversify my portfolio. How would you approach that a client who's
Yeah,
posing
that's
that
a
question?
great question, Eric. And it draws back to what Roshan says is you have to have a customized approach to this is extremely important because sometimes just following general rules of thumbs don't really help you on an individual or your situation where let's just say, for example, somebody has $100,000 and 60,000 is in one stock or one company, and the other 40% is just in a long-term bond that technically meets the 60-40 criteria, but as far as diversification, there's a lot of risk built into there. So what you own and the different types of things that you own as far as investments, for example, let's take the bond aspect of the 40. Are you in long-term, short-term bonds? What types of bonds are you on? What's the credit or interest rate on it are all factors that you have to look in. So just diversifying either further into it is a really important concept that people just need to understand about this approach.
Yeah, and when we're talking 60-40, Adrian, I definitely see your point that is a lack of diversification, you technically fit that. But in my mind, I'm typically on the most basic level thinking 60% in the S&P 500 and then 40% in the aggregate bond index. So you do have the diversification of the holdings within them. Where I'm seeing the flaw right now is that they're all heading in the same direction, and that's down right now. If you guys remember and look back, it stands out to me in particular. I believe it was 2018. No, it was 2019. In 2019, you had both bonds and stocks go up. So we had, and they both did better than they typically do in that same year. We had the positive side of this. Unfortunately, now we're dealing with the negative side of this, and it's to a greater degree.
Mm-hmm. And well, that in a way kind of makes me excited on what you just talked about, Roshan, where let's just say there's just a broad decline within stocks and bonds. Then I think if a valuation investor heard you say that, that makes them very excited, because if you own something where the valuation is looking better and better, and something that has great growth prospects is looking cheaper and cheaper, that's where opportunity lies. Depending on what your time frame is, that's a big part of it. But far as a valuation standpoint, that's where really opportunity begins to thrive.
Yeah, that's therein to me lies the struggle right now in this market, where I think we still have rate hikes on the way. We still have, I think, further declines on the way. But then, if you look at individual companies, you can find some good deals out there as well. So I am extremely optimistic about where things are heading in the next few years, but I am still extremely concerned about where things are heading in the next few months.
So the silver lining, it seems to me, about some of this is for income-oriented investors, the fact that bonds are moving off of the zero interest rate area or the 1% interest rate area up into the 4% area. I think in the long run that will serve those clients well. And also, if you just are tracking forward projections of forward returns to all asset classes, but stocks included, both domestic and international, large and small, developed and emerging, et cetera, what you're finding is pretty much uniformly those projections now have gotten more optimistic about the next decade, precisely because we've come off some of the extremely high valuations that we had. Having said that, I want to answer the question that I posed a little bit earlier, which is how would you, if you're talking with a client who's saying, "Come on, I mean, help me out here. What should I be doing?" Well, there's a few things that we're doing, and you fellas can talk about what were some of the approaches that maybe you've used in your practice. But I think Adrian, remember the episode that we did last November on bond substitutes?
Yes.
Yeah, so we've been not replacing every bond position in clients' portfolios, but at some level, we've been using bond substitutes that have helped to soften some of the downside in this. In some of those cases, it's buffered instruments, structured notes in the form of ETFs. In some cases, it's structured notes outright. In some cases, it's treasuries outright that we hold until a nearer term maturity date. In some cases, it is focusing on some stocks, believe it or not, and using stocks that have attributes, or what we call factors, that have a strong basis for long term, not always, not in every period, but long term outperformance. I think we've talked about this a bit. For example, the portfolio that I am using, or the portfolio models that I use for stocks, direct ownership of stocks, are either mildly or strongly biased toward high quality in the selection of those stocks and looking for dividends. And that has really been amazingly helpful in this phase, just focusing on high quality companies and then getting paid to wait handsomely. In some cases, some of these are paying, in the neighborhood of 7% per year. It just does so much to soften some of the downside through all of that. So this is not a recommendation for any one client. This is by no means a blanket prescription, but focusing on quality, focusing on dividends, focusing on things that have some built-in capacity to resist the downturn. I think all of those are useful elements. And we could also talk about alternatives, which we've addressed in a previous recent episode. You can pursue that episode in our all episodes tab if you're interested to learn more there.
While researching this and looking into this topic today, I did find a variety of ideas that are worth looking into. One, Eric, is what you described. I saw someone saying, well, instead of 60-40, maybe it's 60-20-20 with the 20 to bonds, 20 to alternatives. And once again, as we always say, these are ideas, not advice. Please talk to your advisor. These are things for you to research. And I'm not necessarily saying that's right. I've also saw things out there where it said, well, right now we should flip the 60-40, 60 bonds and 40 equities. So I only bring up these possible ideas for you to say, well, there is this. We've presented this topic because it is popular in the financial press and because a lot of investors own that kind of portfolio. We're not necessarily advocates for or against this strategy.
Roshan, I'm surprised a little bit that you haven't talked about options, because seems to me that one of the ways, and we've also addressed options in a pure sense in a previous episode, but one of the ways that options can be used is to generate income. Yes. and again, they don't, as long as they're held to expiration or until they're exercised, they're not going to drop in value in the way that we normally think about other things that you buy and you hold, that they can drop in value.
I definitely see an opportunity there, especially to generate income in this kind of environment, but it's got to make sense. Because I was literally looking at it this morning, where there are some securities where you can get really good option premium and it's worth it to collect that income. There are others where, you can get some premium, but it's not, in my opinion, high enough to be worth writing to collect that income. So that is definitely a way to either, from the perspective of softening the blow and collecting income, it's definitely a way you can do that. Or from the other perspective of using it to protect your portfolio, that is something that is available to you as well. It's just got to make sense. So to me, the 60-40 conversation is a little bit of an easier one to have than when you talk about the options, because I think that just takes a lot more research and analysis, because it varies so much more. And then in addition to that, it can carry so much more risk if you do it incorrectly. So if you are using that to protect your portfolio, or you're using that to collect income, I would just, as I always do when we talk about options, I would just advise caution.
Well, gentlemen, I don't have much more to say, I think.
I'll tell you, just to bring it back, we had all said, I think for different reasons, that the 60-40 is not dead. Adrian, you gave your reason of why, and I'm paraphrasing, but it was investment strategies have their time, and this is just not a good time for the 60-40 strategy, and it'll likely come back. I'll give my answer as to why I don't think it's dead. Well, one, in general, when you talk about things being dead, I wonder the opposite. Is this the time to get in? But then, Eric, similar to what you said, valuations are looking better. Interest rates are looking better if you're getting into a portfolio like this. So I do think the time will come for this. But if I had to pick a time frame, I think it'll be a little while. as I think rates will go up, and you might see this come down a little bit further. And then going beyond that, if I'm looking at the 60-40 after rates start to turn, I think there'll be a greater opportunity in the equity side of things. So if you have some variability of this, as Eric had you shown from 60-40 to 60 stocks, 40 bonds, in the example we're using, to 70-30, 70 stocks, 30 bonds, and so on, it may be worthwhile looking at which of those mixes are better in which times for the people who are going to use our discussion for research purposes. Eric, anything to add on your thoughts? You had said you don't think it's dead either, as to why.
Yeah, I do think these, as Adrian said well early in this episode, these things run in cycles, and we're in a cycle now. This too shall pass, and so I don't throw out a strategy just because it didn't work in 1 year or even for an extended period of time. In the long run, the principle, we can, if we step away from the language of 60-40 and just say the principle of having different assets in a portfolio that don't always or don't normally behave in the same way at the same time is a useful way of gaining an edge in risk adjusted returns. And that, while I don't think that's the perfect form of diversification, simply not in its extremely reduced version of the S&P 500 as 60 and the Bloomberg Aggregate Bond Index as 40. I certainly do think that if you think about the broad principle of well diversified portfolio of commonly inversely correlated assets, that's a good strategy to have for a good portion of your portfolio.
Excellent. This has been another episode of the Retirement Lifestyle Show. Please like, subscribe, give us 5 stars, share the link, tell your friends and family, and we'll be back next week with another great episode.